Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, Asian financial markets tumbled today, as geopolitical tensions surged following Israel's military strike on Iran. The escalating conflict rattled investor sentiment, prompting a flight from riskier assets and triggering a rally in oil prices. Israel confirmed it had launched, quote, preemptive strikes, end quote, targeting Iranian nuclear and military facilities, according to media reports, raising fears of broader regional conflict. Anticipating retaliation, Israel declared a state of emergency, and uncertainty sent shockwaves through Asian equities, currencies, and commodities. Japan's Nikkei 552 index dropped as much as 1.7%. It was trading when the news was released. Market volatility surged, with the Nikkei average volatility index spiking over 36% to a reading above 32. South Korea's Kospi index also lost 1.3%, and US S&P 500 futures slid 1.6% soon after the news. Oil markets saw a sharp rally on fears of supply disruptions from the Middle East. Crude surged more than 13%, climbing above $78 per barrel. Quote, this is going to potentially alter the lower inflationary trajectory in the US and Asia Pacific observed since the beginning of the year, end quote, said Wee Kun Chong, macro strategist at BNY in Hong Kong. Quote, the escalation is a blow to risk sentiment, end quote, said Tony Sycamore of IG Australia, adding, quote, markets are not in the mood to wait for further details, end quote. With tensions running high and global markets reacting sharply, investors are bracing for further volatility in the days ahead. Meanwhile, India is mourning the country's deadliest aviation disaster in over a decade after an Air India flight bound for London crashed shortly after takeoff from Ahmedabad on yesterday, killing more than 240 people. The Boeing 787-8 Dreamliner went down just minutes into its ascent, leaving only one known survivor and igniting an international investigation into the cause of this tragedy. Air India confirmed that among the 242 passengers and crew were 169 Indian nationals, 53 British citizens, 7 Portuguese and 1 Canadian. The lone survivor is receiving medical treatment, while families across multiple nations are reeling from the loss. The U.S. Department of Transportation has pledged to support India's Aircraft Accident Investigation Bureau, and the National Transportation Safety Board, NTSB, joined the probe. Boeing, the plane's manufacturer, has dispatched a technical team to assist and express condolences. This incident marks the first ever fatal crash of a Boeing 787 since its introduction in 2011. The aircraft, lauded for its fuel-efficient composite materials and global range, had previously maintained a clean safety record. However, it has been dogged by production and quality control issues. Battery fires grounded the 787 fleet for months in 2013, and deliveries were paused again more recently due to quality concerns. And Thursday's crash lands amid a period of intense scrutiny for Boeing. The company is still recovering from the 737 MAX disasters in 2018 and 2019 that killed 346 people, as well as the dramatic mid-flight door plug blowout on a 737 MAX 9 in January of 2024. That incident prompted a leadership overhaul and the appointment of a new CEO in August. Aviation experts stress it is too early to determine the cause of the Air India crash. Boeing shares fell 4.8% on Thursday, underscoring investor concerns that this latest tragedy could derail the company's ongoing efforts to regain public and regulatory trust. Next up, for the fourth consecutive month, US inflation has come in below expectations, challenging predictions that President Donald Trump's trade war would sharply drive up consumer prices. Data released on Wednesday by the Bureau of Labor Statistics showed that core inflation, which excludes volatile food and energy prices, rose just 0.1% in May, undercutting forecasts and suggesting that tariff-related cost pressures have yet to be passed on to consumers in a meaningful way. Year-on-year, core CPI rose 2.8%, slightly below the 2.9% projection. Prices for goods excluding food and energy commodities were flat, with notable declines in categories such as apparel, new and used vehicles, airfares, and hotel stays. The reaction in financial markets was swift. Treasury yields dropped, the US dollar weakened, and the S&P 500 opened higher. Traders are now pricing in a 75% chance that the Federal Reserve will cut interest rates by September. The latest inflation data adds to growing evidence that US firms are largely absorbing higher import costs or adjusting inventory strategies rather than immediately raising prices. Quote, the build-up of inventory in advance of the tariff hikes may be contributing leading to delayed pass-through, end quote, said Fitch Ratings chief economist Brian Colton, who still expects core goods inflation to rise in the months ahead. Some import-heavy categories did show signs of tariff-related inflation. Toy prices saw their biggest jump since 2023, and major appliances rose at their fastest pace in nearly 5 years. Yet overall price increases remain contained. Gasoline prices, for instance, fell 2.6%, helping to moderate the hardline CPI figure. Treasury Secretary Scott Bessent credited Trump's trade policies for curbing inflation, arguing they challenged a, quote, decades-old status quo, end quote. However, economists remain divided on the longer-term impact. Critics argue that tariffs could eventually lead to higher prices and hinder efforts to reshore manufacturing. We will have to wait and see. Meanwhile, the US dollar fell to its weakest level in 3 years on Thursday, following fresh trade threats from US President Donald Trump. The greenback dropped as much as 1% against a basket of major currencies, including the pound and euro, amid heightened concerns over trade and geopolitical tensions. Trump announced plans to send letters to key US trading partners outlining new tariff rates as a 90-day pause on reciprocal levies, as he calls them, nears expiring. The news reignited fears of a global trade conflict. This is one of many areas we'll be following closely on Market Update, as the coming weeks are going to see huge developments. If you want to be on top of all these developments as they happen, make sure you subscribe to Market Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Next up, we move to Europe. The UK is experiencing one of the most significant wealth outflows in its modern history, as high net worth individuals flee the country in response to the government's sweeping tax reforms targeting non-domiciled residents. The abolition of the long-standing non-dom regime has sent shockwaves through London's financial elite, with exits accelerating and the economic implications becoming harder to ignore. Since the government scrapped the 2-century-old non-dom tax break in April, thousands of wealthy individuals have left or signalled their intent to leave. According to a Bloomberg analysis published this week of UK company filings, over 4,400 business leaders have registered a new country of residence in the past year, with April alone marking a 75% rise in exits compared to a year earlier. The policy, aimed at bolstering tax receipts by an estimated £33 billion over 5 years, risks backfiring if more than 25% of the non-dom population departs. Early signs suggest that threshold may be rapidly approaching. Legal and tax advisors report that between 15% and 66% of their non-dom clients have either left or are actively planning to, taking with them an estimated $110 billion in personal wealth. Critics argue the move is a high-stakes gamble. Non-doms, who comprise just 0.1% of the population, contribute over £8 billion in taxes annually, more than 1% of all UK tax receipts. Bloomberg calculates that each non-dom pays an average of £120,000 per year in employment, capital gains and income taxes. And of course, by living in the UK, their spending is pumped into the economy. Their sudden withdrawal threatens to destabilise segments of the economy, from private banking to high-end real estate and philanthropy. Quote, "Every day there's another client going," end quote, said tax advisor Mark Davies, who estimates that 2/3 of his 300 non-dom clients have already left or will soon depart. The UK's top relocation draws, education, lifestyle, diversity and tax, are now overshadowed by dismay over inheritance tax changes and perceived instability. European and Middle Eastern financial hubs are primary beneficiaries of this UK wealth exodus. The UAE, particularly Dubai and Abu Dhabi, is attracting hedge fund executives with tax-free incentives. Italy, with its €200,000 flat tax regime, is luring private equity professionals. Monaco, Cyprus and Switzerland are also gaining ground. Meanwhile, back in London, the impact is rippling through the city's elite services sector. Family offices are scaling down, private clubs are losing members, and prime property sales have stalled, even as Labour rolls out sweeteners such as a new 4-year simplified tax regime for recent arrivals. The damage to perception may be lasting. As investor confidence wavers and more ultra-wealthy families put contingency plans in motion, the UK risks turning a tax reform intended to raise revenue into a costly economic miscalculation. And as the country faces a series of brutal economic crises, this is a miscalculation it cannot afford to make. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Friday. There may be an extra episode this weekend, so I'll either see you this weekend or for a new week of updates on Monday.